Hello and welcome to the Female Property Expert Podcast. I'm Emma Morby and I try to take the mystery out of property investing and break it down into simple kind of actionable steps. So whether you're just starting out or you're looking to grow your property portfolio, this is definitely the place you need to be. So today's episode is all about the money. Specifically, how can you fund your first property deal? I get asked this all the time. So for many, this is possibly the biggest obstacle when starting out. But don't worry, okay, because at the end of this episode, you'll have a much clearer idea of how to find the funds you're going to need and how to do it smartly. Let's get started. So we need to look at the basics of funding a property deal. So let's try to understand it by talking about what property investment funding actually means. Now, it's not just about saving a pile of cash to buy a house outright. That's a massive misconception that often stops people from even considering property investment. They won't even look at it. In reality, there are lots of ways for funding options that are available to help you get started. Even if you don't have a lot of capital up front, you are going to have something. But some people will pop it on credit cards just to get themselves tied over until that property starts making profit or until the development's built, for instance. So before we dive into the specific methods, I want to emphasize that property investing is accessible to more people than you actually think. So if you're sat here listening thinking, I'm not sure I can do this, there are two reasons. One, you don't know about the funding. And two, because you don't have the confidence, because you don't have the knowledge. So those two are really easily solved. You can go on a training program to educate yourself. We deliver training programs. So if you are interested, there's a link below. And they're 12-month programs and they're really, intense, and you have support and guidance. And this isn't just a case of here's a 3-day program and off you go. This is a really in-depth training program. And we're going to cover off the funding part now. So that will give you your confidence. Okay. So why is it important to understand your funding options? So when it comes to property investing, understanding how to leverage other people's money is one of the most important skills that you can have. You don't necessarily need to have all the money yourself, whether it's through mortgages, private investors, creative funding methods. The key is to know what your options are and how you access them. Before you even start looking at specific funding options, take a moment to assess your own financial situation. Okay. What's your current savings? What can you afford to invest without putting yourself under huge financial strain? And how much are you willing to risk in case something doesn't quite go according to plan? You need to have clarity on these points because it will help guide you to find the right funding solution. So now I'm going to run through some traditional funding methods. Okay. So most of you will have heard of mortgages. So let's talk a little bit about the most common form of funding, which is the mortgage. If you're buying a property for investment purposes, you'll likely be looking at a buy-to-let mortgage or some form of maybe commercial mortgage if it's a serviced accommodation property. The key difference between standard residential mortgage and a buy-to-let mortgage is that the property you're purchasing is intended to generate an income, a kind of a rental income. Lenders will typically require a larger deposit, usually around 20 to 25%, sometimes as high as 30%. Interest rates are often slightly higher. Now, the great thing about mortgages are that you don't need to have the entire property cost up front. So if you're looking at a house that's £200,000 to buy, you may only need £50,000 for a deposit. The rest is covered by all the lenders. Now, you're probably sat here thinking, wow, £50,000, I don't have that kind of money. But it's okay. There are different ways in which you can fund these deals. I'm going to cover that off in a minute. So how lenders assess you, let's quickly go into that. Because quite frankly, it's how you actually get the mortgage. So what are lenders looking for? I think it comes down to 3 main factors. 1, your credit score. This is a key factor for lenders. So the higher your credit score means you're seen as kind of less risky, which will help you secure better interest rates, better deals on your mortgage, that sort of thing. Then comes your income. Lenders want to make sure that you can afford the monthly mortgage payments. So basically your income along with the potential rental income projects, might play a role in this. Now, some lenders will ask for you to earn a base minimum of £12,000, for instance. Some lenders won't take it into account at all. But I always say, if you are working, it's worth sort of stating what your income is. They're not going to take any money from you. They're not going to worry about all your dependents like they would do a residential mortgage. They just need to know that you have the funds to cover it if it goes wrong. And then there's your deposit. So as I mentioned, you'll need at least probably 20 to 30% for a buy-to-let mortgage. The bigger your deposit, the better the terms, as you can imagine. But don't get discouraged if your credit score isn't perfect or if you don't have a massive deposit. There are other ways to fund your first deal, and I'm going to cover them now. So we call it alternative funding methods. I'll start with a bridging loan. This is short-term finance for quick purchases. So bridging loans, short-term finance options that can help if you're looking to secure a deal quickly or you're looking to renovate a property before refinancing. Now, these loans are typically interest only, and they are designed to bridge, as you can imagine, a gap between buying the property and securing long-term finance towards the end, once you've done renovation work, for instance. So let's say you found a really great property deal. You need to move fast. Bridging finance could help you buy the property now and make all the necessary improvements, and then you can refinance with just a traditional mortgage or sell it and make the profit. However, a word of caution. Bridging loans tend to come with quite high interest rates and fees, and it is crucial to have a very clear exit strategy in place. So whether that's selling the property or securing long-term finance and then renting it, you have to have a strict deadline and very, very clear exit strategy. Next up, we've got private investors. So this is basically using other people's money. Private investors are an excellent funding option. So if you have a solid deal, but you don't have the funds yet yourself, you can approach an individual or company sometimes who are looking to invest their money for a good return. Because often what happens is your return will be better than the bank. And now this could be structured in various different ways. And for instance, maybe you offer them a fixed return on their investment, or perhaps they take a percentage of the profits once the property is sold or rented, whatever you want it to be. But the key here is trust and transparency. Private investors need to feel confident that their money is safe with you and that you have a plan for making their investment grow. They want to see that stuff. Now, if you can build that trust, private funding can be a very, very good way to getting started without using your own money. People often ask me, where do you find private investors? And if I'm honest, they are everywhere. And I mean everywhere. You might have a friend whose nan has passed and left £30,000. There's an investment for a property up north. You might have some inheritance that's coming your way. You might know someone who has a successful business and they have £200,000 sat in their business account doing absolutely nothing. And they can loan it to you and you can pay it back to them. There are so many different ways to find private investors that you just literally have to open your eyes and go and look for them. The other thing that people find is that they don't have the confidence to speak to private investors. And that comes down to your knowledge. It means you haven't got enough of a solid knowledge base of the industry you're in because you don't feel confident in being able to do that. It's overcomable by training. Go and learn whatever strategy you want to do. We deliver training as a company. So literally learn, educate yourself. Anyway, slightly off topic. So government schemes will be next. In the UK, there are also government schemes that can help you get onto the property ladder. Again, this is more residential, So for instance, you've got Help to Buy scheme. This allows you to purchase, well, actually the Help to Buy scheme has now changed slightly. It's got a slightly different name, but it allows you to purchase the new build and it normally will give 5% towards your deposit. Sometimes it will go as high as 15%. And although it's mainly for residential property, so this would be you buying your own property, not an investment property. Some investors start with a residential property. So you might buy your first property and live in it, and then later convert it into a buy-to-let property. So it's worth looking at these schemes to see if they fit within your strategy, your 5-year plan or your 10-year plan. Next on the creative finance options, is vendor finance or seller financing. Now, this isn't talked about much, but this is a really creative strategy that It's not talked about, but is incredibly effective. So vendor finance, also known as seller finance, is one of those strategies which I find mind-blowing, and not many people do it. So in this case, the property seller agrees to finance part or all of the purchase themselves. So this allows you to bypass traditional lenders. And this is typically used in situations where the seller wants to move quickly or might struggle to sell the property through kind of conventional means. So you might agree to pay a small deposit up front to the seller, and then the rest is paid over time through installments. So it's like a flexible option. It can be a little bit more complex. I'm making it sound very easy, but you do need good lawyers. My advice would be make sure you get legal advice on this before you explore this route. But we had a friend recently who couldn't get a mortgage, or actually didn't want to get a mortgage from the traditional bank lending because the interest rates were so high. So they spoke to the developer and said, look, how about for the next 3 years, we give you a deposit and then we pay you an installment every month for the next 3 years, and then we'll remortgage when the rates look better, and then we'll buy. Developer was like, great, that sounds brilliant to me. And off they went. Joint ventures are another great option. Okay, this is where you partner with someone who has funds, but perhaps lacks time or expertise to invest in property themselves. So basically, you're bringing the deal and the property management know-how, and they bring the money. So you can then split the profits based on contribution each party makes, or you can have a fixed profit on the end. But joint ventures can be a win-win, especially if you're just starting out and don't have a lot of capital. But what I would advise is that you make sure you choose the right person to joint venture with, because there are a lot of people out there who, how do I put this nicely, who won't deliver what you're expecting. And I say that in the sense of maybe it's a loan shark, maybe it's an investor who's a little bit dodgy and you're not aware of them. Maybe it's someone who says they have money, but when it comes to crunch time to do renovation work, they actually don't have that money. You need to make sure you look into these people. At the end of the day, an investor is important for you to work with, but you're also important to that investor because you're generating them a return on their investment. Now, I've talked about kind of different types of funding, but next I want to cover obviously tips for securing the funding itself. Now, for me, whichever funding route you take, one thing remains crucial: having a solid business plan. So whether you're approaching a lender or a private investor or a potential joint venture partner, you need to be able to show them how you plan to make a profit. So in your business plan, it should have clear projections. This might be rental income, costs, expected return on investments, and then also contingency plans. So what happens if things don't go as expected? Now, we call these exit strategies. So if investors and lenders want to know, then you can say, these are the potential risks, and this is what I've done to mitigate those risks or to lower the impact to us from those risks. Building relationships with mortgage brokers, lenders, and investors is a really great way to improve your chances of securing funding. Often a broker can find deals that aren't available directly to the public, and they build trust with investors, and that can lead to kind of long-term funding partnerships. So don't just be closed-minded when you're looking at these. Don't be afraid to network. Go to property meetups, put yourself out there and meet different types of people. We work solely with mortgage brokers because they can pitch our product, our asset, our property we want to buy to the lender much better than I can. It's what they do for a living. And yes, you're going to pay a fee for that. But actually, 9 times out of 10, we will get funding. So let's wrap up quickly. So today I spoke about various funding options for your first property deal. And that included traditional mortgages, bridging loans, private investors, the creative strategies like vendor finance or joint finance. And I want you to remember that the key is to assess your personal situation, okay? Understand your options. Be strategic about which funding method works best for you, for your investment plan. And then once you've found a property, execute it. Funding is often seen as kind of one of the biggest hurdles in property investing. And that's because of some money blocks that you might have. So it's money mindset that work with you. Now, we did an episode on money mindset a few weeks back. So please go back and refer to that. But it doesn't have to be difficult. Once you know how to leverage the different types of finance and you have a fairly good credit score, it becomes a much more manageable process. Remember, you don't always need to have oodles of cash or money. Sometimes you can go and use somebody else's money. And often, if it's giving them a good return, they will quite happily invest in you, invest in that deal. Now, as always, if you found this episode helpful, please subscribe, please leave us a review. They all help bump us up on the podcast annals. I'll look forward to seeing you all next week. If you have anything that you would like me to cover as a topic, please pop it down in the comments section. If you'd like to learn about our training, please go down below in the comments section. There'll be a link. You can click on it and it will tell you a little bit more information about us and the training we deliver. My aim really is to make property investing as simple as possible. So go out and wish you happy investing.